Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending March 20th, 2026. So I was looking for a title for this review this morning. I settled on blurry picture because, there's just so much uncertainty flying around. This week, Mr. Trump was pressuring the NATO allies to get involved, but saying that he doesn't need them. Of course, no NATO country has been attacked directly, so Article 5 of the NATO Charter cannot be really called. But we've heard yesterday that many countries, including Canada, are willing to do something about the Strait of Hormuz. So there's that. Iran is still attacking other Gulf countries for multiple reasons. To pressure, now it's hitting oil and gas fields, refineries, so there's some damage that could be long lasting. It's complicated, so who knows how this will evolve, who knows where we'll be in a few weeks, but we're hearing this morning that there might be some boots on the ground on the island of Karg in Iran, where most of the production is just distributed by pipeline, so it can be boarded on ships and then shipped away. So the U.S. could take that island. So of course this would go against what Mr. Trump was saying, no boots on the ground. So again, very blurry picture. So let's just paint the picture here of where we are. And most importantly, I was in the media a lot this week. I was getting asked about the panic in the markets and the broad sell-off, and just show that there's no panic yet, and it's a very ordered sell-off still. There might be panic in the future, we don't know, but we'll just make a quick picture of everything that's going on. So let's start with the look at this week's markets at the close on Thursday. So positive for bonds, so bonds are playing a little bit of their safe haven role, so that's good. Equities down, the TSX was hit a bit more strongly, mostly because of gold. The gold was just so inflated coming into this situation that now it's trading like a risk-on asset, so it's not really a safe haven. If you remember, at some point this year, we touched 5,600 on the price of gold, or close to 5,600. Now we're back to 4,600, so that's a $1,000 swing. We're still up 7.7% on the year, but still, gold is driving the TSX a fair bit here. Price of oil here, well, the picture seems like it was a down week, but it was a very volatile week. We touched above $100 at some point during the week, so very volatile. Within equities, emerging market first, TSX second, EFI third, and then after that in the US, so that hasn't really changed. Canadian dollar down, euro a bit higher, but overall the safe haven here seems to be the USD first. Maybe treasuries, but as we'll show in a few minutes, it's not that obvious as well. So the Strait of Hormuz is de facto closed. So here you have the millions of metric tons of trade that goes through the strait. It's not just oil. And remember that it's 14 million barrels a day of oil that goes through the Strait of Hormuz. It's not 20% of global production. It's 20% of oil that is transported via maritime means that goes through the Strait of Hormuz. Because, for example, in North America, we produce a lot of oil and we send it over through pipelines. So a small detail here, but this is mostly impactful for Asia, most importantly China, because those are the main clients of Iran. But it's not just oil; it's also gas that is transported that way. Gas production has been hit, but also everything that has to do with petrochemicals, so sulfur, nitrogen. We also hear that in Qatar they're producing lots of aluminum because energy is cheap there, and the transport of aluminum in this region also has been suffering or has been halted. So this benefits some Canadian industries as well. So it's not just oil. Oil goes through the ships, but the gas production and the gas distribution is hurting, and the distribution of other kinds of products around the region as well are hurting. So this is very important to global trade. So that's why we have a coalition of countries that are saying that they're willing to help. let's see what happens over the next few weeks. Of course, Iran is unlikely to sit idle on this one, but it's de facto closed. Now, the market reaction. So let's start with equities. Top left, you have the S&P 500, and we're looking at the drawdown, so the pullback from the recent peaks. Minus 5.3% for the S&P 500. Top right, you have minus 7.8% for the TSX. Bottom left, you have 9.6% from AFI, and 8.8% rather for emerging markets on the bottom right. So the message here is that this is still within normal volatility. So correction is minus 10% plus. A bear market is minus 20% plus. And if you look at the chart, we only brought the last 10 years here just to give an idea. But what we're seeing is well within the normal volatility. So an important message here is that if you're seeing this volatility and you're getting nervous about your portfolio, well, it's always good to talk to your financial advisor because maybe your risk profile has evolved, because we're not seeing anything too drastic yet, and you need to be always honest when you build your own risk profile. But what we're seeing yet on a daily trading basis, we haven't really seen a panic day where, let's say, volumes are very high, the stock market just flushes 3 or 4%, and there's blood on the streets. We haven't seen that yet. But on the flip side, we haven't seen the inverse either. We haven't seen on the positive days strong upward volume with a strong accumulation signal. We haven't seen that yet either. So markets are still waiting it out. Positioning is less stretched than it was at some points in 2025 from retail, but also from the systematic players, from institutional players. So there's that as well that supports supports markets, but we see that the market is still in a wait and see approach. It's pretty much the same thing for bonds, for treasuries. Here, just the US 10-year rate. We did pretty much a round trip. But look at the rates lower move was before this situation. That was when the U.S. economic data was a bit lackluster and markets were starting to price multiple rate cuts from the Fed. Now that we have this oil shock, which should be inflationary, markets have depriced that and we're back to where we are. So no panic yet. But the chart on the right, you see that the dominating factor is the 10-year inflation expectation. So the blue line on the right chart, this is the break-evens, 10 years. That shows that markets are seeing something that could be inflationary for the long run. It will depend on how long the oil shock lasts. If it's only a few weeks, a few months, 1 quarter, likely this won't have a permanent impact on inflation and central banks can look through it. But if it lasts more than 2 quarters, let's say, then you will start to have inflation expectations that can become de-anchored, and then you will see some businesses that will have to raise their prices because the price of shipping is rising, and then you have a broader inflation shock, and then central banks are kind of forced to act. So we're not there yet, but the market is right in thinking that this should be inflationary, and as I showed last week, the impact on growth is kind of muted, but the impact on inflation can become quite significant quite rapidly if the situation stays for more than 1 quarter. Now looking at currencies. Top left, you have the USD. As you can see, the safe haven here is likely the USD. Went from about 97.5 to 100 on the DXY. Where we've seen the stronger move downward, bottom left, the euro. So in Europe is dependent on energy imports. So of course, an oil shock is negative for the currency. On the right, CAD on the top, yen at the bottom. Both indices here are inverted because in markets we kind of look at them the other way. But CAD first pretty much sideways, some volatility but sideways, so no real move on the CAD. But the yen has depreciated in pretty much in a straight line from about 152, 155 to about 160. So a depreciation of the yen. And also Japan is an important energy importer as well. So just to wrap up the markets, no panic yet, no clear signals of a deterioration of let's say risk appetite, or let's say signs of beginning of to accumulation, or just that we've found the floor. So we have no signal yet, but we still have no panic in the markets. So that's interesting in itself, and we keep you posted on how things evolve in our view. Now, Bank of Canada and the Fed very quickly, both kind of send the same message, but they're in very different positions. So on the left, you have the Bank of Canada, so they're holding, but they warn of the downstream effects of the Iran war. And the chart here shows that markets, before this situation, were thinking the bank will not move by the end of the year, and now it's thinking that it might hike 2 times by the end of the year. So we still think that this is an alternative scenario. This is not our base case scenario. It would take, as I've said a few times, a shock that lasts for a few quarters before the bank feels forced to change its stance. We think that 225 is still the right place, and there's still lots of headwinds for the Canadian economy, with trade, with the labor market, which has deteriorated. Inflation is still rather weak compared to other places in the world here, so the bank can afford to wait. But yes, we need to look at a scenario where the bank hikes, but we would need to see a prolonged oil shock. So this is our view. On the right, for the Fed, they're also holding. Inflation worries because of this situation, but they have not yet finished their normalization process. They were still seen as cutting throughout the year, and their dot plot still shows 1 cut in 2026, 1 in 2027, but now markets are not so sure, and they're pricing in absolutely nothing by the end of the year. So nothing too drastic here, but less of a dovish tone, more of a hawkish tone from central banks. This was the innovation on the week, and of course this can create some headwinds to risk appetite throughout markets, so we'll follow that for you. Now, what we'll be watching next week, very light week on the macro data. I don't know if it's going to be light on geopolitical front, but for macro data, Bloomberg Nanas Confidence Index in Canada and in the US, global PMIs, and University of Michigan Confidence Index. So it's always a pleasure to serve you through this turmoil. So we'll keep you posted on how our views evolve. If you appreciate the content, please share, and of course, come back next week.